In addition to deducting business expenses, a taxpayer may be able to be deducting business losses when they get rid of business assets. There's even a possibility of having a gain when you get rid of a business property that's going to be taxable. So we'll learn about something called Section 1231 assets, the disposition of business assets in chapter number 3. But even before doing that, in chapter number 2, we're probably going to learn about how to calculate the basis of business assets. So here's some terminology. In your previous accounting classes, you learned financial accounting rules and you reported revenue and minusing out expenses to get a company's net income or net loss. But now, here in a tax class, you're learning tax rules of reporting revenue or income and the amount of expenses that you can deduct. And the difference is called not net income or net loss, but taxable income or a tax loss. And when you figure out this taxable income, only then you would multiply this by various tax rates or percentages to get the tax for the year. So when you prepared financial statements, like an income statement, you were using GAAP rules, generally accepted accounting principles. Now, when you're preparing your tax return, you're using tax laws. We're going to see though that one of the expenses here on your financial statement is the income tax for the year. But because this taxable income and this net income is different, there may be different ways of calculating that tax expense on the financial statement. In other words, you just don't take this tax and place it here as an expense. We're going to see something called deferred taxes, I believe, in chapter number 6. So let's take a look at accounting periods. In other words, what period of time are you going to be doing your tax return? And of course, all of us know we prepare a tax return every year. And for individuals like you and me, we use a calendar year. In other words, from January 1st through December 31st, we would report all our taxable income and deductions and file that one return. And that is possibly true even for businesses. But again, usually individuals like you and me, we go with a calendar year. I have never seen an individual not use a calendar year, although I've seen many corporations and probably partnerships using non-calendar years or here a physical year, where most times the year end is the last day of a month other than December, like January 31st. If this is your year end, tell me what's the beginning of your year? Really, it's just the next day, but 1 year before that, right? The next day would be February 1st, but then that's February 1st from the previous year through January 31st. So here's the start of the next year, going all the way through 12 months to January 31st. The purpose of having a physical year is maybe that's more of a natural seasonal workflow for a business versus a calendar year. Another possible accounting time period is something called a 52, 53 week year, where your year would end on the same day of the week closest to the end of a certain month, like the last Saturday of February would be your year end, and the very next day, Sunday, would be the beginning of the next year. Um, or maybe the last Saturday closest to the end of February, which could possibly be in March, and the very next day would be the beginning of the next year. The purpose of using a 52, 53 week year is that maybe accounting records are kept so, like they keep track of trends by the week. Okay, so your year is usually chosen on your first tax return. Again, individuals usually use a calendar year. Here it says that certain flow through entities will learn about something called an S corporation, and we'll learn about partnerships. If the shareholders of S corporation and partners of partnerships are individuals, then usually these two business entities have to use a calendar year like the owners. A sole proprietor, again, an unincorporated business, individuals like you and me would also use a calendar year. Usually it's corporation and partnerships that don't have individual partners that would have a physical year. I mentioned before that you've taken financial accounting classes and learned GAAP rules. Now you're in our tax class and you're learning tax laws. The rules for taxes and the rules for financial are somewhat similar, but are sometimes different. And when the tax laws are different, you got to use the tax laws to prepare your tax return. Here it says that tax laws kind of accelerate income. What the government wants you to report your income as soon as possible so you pay more taxes. But it tends to postpone the deducting of expenses. So again, increasing your taxable income and probably paying more taxes faster. So generally there's three big types of accounting methods. The ones you and I are familiar with as individuals is the cash method, where we report income when we receive it and we report deductions when we pay for it. So all you're doing is following the money. Okay, and this is probably the simplest of all the different accounting methods. Now, what you learned in your financial accounting class is the accrual method. Now, when revenue is recognized, I believe it's completion of performance obligations, you have to report the income. And when you incur expenses, that's when it's deductible. The accounting rules are slightly different, again, trying to accelerate income and defer deductions for tax purposes. Most businesses that do use the accrual method don't use a pure accrual method. It may be a combination of accrual and cash, or sometimes they call that a hybrid method. So an example would be a merchandising company that buys and sells inventory. Tax rules may require that the buying and selling of inventory be treated under the accrual method, but it is possible anything else for the business can use the cash method. Like here, you buy and sell inventory. Remember, accounts receivable, accounts payable for the inventory. But when you, let's say, charge for service fees, you don't have to go accrue. You can just wait to collect the money and then report the income. Or when you receive your utility bill, you don't have to accrue it. You can deduct it when you pay for it. If that's the case, then you're using the hybrid method. You would pick the method of accounting on the first tax return you file for the taxpayer. Here it says that large businesses, usually with 25 million of gross receipts averaging over the past 3 years, have to use this accrual method. Cash method, again, that's what we use. Here it says it's flexible. In other words, you can possibly postpone the billing to your customers so they don't pay you, and you can defer maybe collecting that income, maybe just a few days and pushes it into the next year. Or you can accelerate paying your expenses at the end of the year and go Christmas shopping to buy your business expenses, pay your business expenses to increase your expenses for that year, the deduction for the year. So cash method is relatively simple. Again, all you're doing is following the cash. So maybe you can do your own bookkeeping here versus hiring a bookkeeper. But here it says it's poor matching of income and expenses. The matching principle is not a rule for taxes. The matching principle is a rule for GAAP, for financial accounting. So even though it may not give you a good idea of your profitability, it's simpler and more flexible. And again, you have to go accrue method if you usually have an average of 25 million of receipts over the past 3 years. Otherwise, you can use the cash method. So accrue method, and again, this is what you guys are usually familiar with, at least accounting majors. We have to make sure that the amount of income is not only um, determinable, okay, the amount, but all the um, here they call it all events test has to have happened. In other words, it have to be a legally receivable or payable item. Yeah, here we're talking about income. So you know you're gonna get this amount, and you've done the work already, and the customer recognizes that. It may be here it says that it may be required that you report the income even earlier if you receive it in advance. Yeah. So you got the money up front. You remember, let's go debit and credit. Here's one of the accounting entries you've learned in the previous accounting class. So you got the money, debit cash, but you didn't do the work yet, so you cannot credit the revenue. So what do you credit instead here? You remember that account called unearned fees or unearned revenue? What type of account is this? Okay, it's not revenue, but it's a liability. And then general rule is that accrual basis taxpayers, if they get the money up front, you may not be able to report the liability. You got to report the revenue instead, and you pay taxes on this right away. Okay, there's always exceptions to this rule here for unearned revenue. In this example, we have Ben, who's already provided services and bills his customer Ace for 12,000. Ace disputes the amount, and when he's claiming 8,000 is the proper amount. So the question is, how much should Ben recognize under the accrue method? Well, if it's cash method and he hasn't received anything, the amount would be zero. But here he's already done the work, and the only thing in question is the amount that's determinable. Since 8,000 is for sure, that's the amount that he should report. Yeah, 8,000, at least for this year, under the accrue method. So we've talked about amounts received that are prepaid before doing the work. So the general rule was that you cannot defer, you cannot postpone the amount you receive in advance. You gotta pay taxes on it. But what's a rule without exception? So here's the exception. If the amount is reported as deferred on your financial statements, you get to defer at least up to next year anything that work is done for the following year after the year is over. This exception doesn't apply to any prepaid rent you receive or any prepaid interest you receive. Those amounts you got to report right away. So let's look at an example. Ben again, here he is giving dancing lessons, and on September 30th, just 3 months away from the end of the year, he collects $2,400 for 2 years worth of services. Again, 3 months this year and the rest next year and the following year. So if he's under the cash method, we know already he got the money, so you got to report all of this right now. But how about the accrual method? If Ben prepares financial statements and uses that unearned fees account, he gets to report only 3 months worth of income this year, and the rest of the income has to report it next year. Even though it's going to be beyond next year, he gets to defer only 1 year. So 3 months recognized this year and the rest next year. You can see the answer here on the next slide. 3 months worth this year, and then the rest, 2100, all next year because you only can defer it for 1 year, not over the following year after that. We've talked about inventories. Generally, when you deal with inventories, you have to go the accrual method. An exception to that is if your gross receipts are averaging less than 20 million, then the purchases you buy during the year, here it says you can treat it as non-inventory items. So just like before, if you're going to sell it all next year, you get to deduct it now, this year. Uniform capitalization rules. If you remember your accounting 202 class or the intermediate accounting cost accounting class, you did the accounting for a factory, and the hard cost was dealing with manufacturing overhead to apply it to your inventory, the so-called indirect costs. For tax purposes, it's a little more strict, where things like warehousing costs, even the administration costs for your business, part of it has to be allocated to your inventory and only deducted when you sell the merchandise. And here you can see the so-called small business exception, where if your sales are averaging less than 25 million, this rule doesn't apply to you. Here's a terminology you've seen before: FIFO, LIFO, and the specific identification method. Yeah. Many big businesses use the LIFO method to help save taxes. Um, but then they have to use the LIFO method for financial reporting purposes. Here's our last slide. The accrual method for expenses is somewhat similar to the accrual method for income, the so-called all events test. But to um, to ex to not have expenses accelerated faster, what they do is look at the underlying activity, and it has to be done. Whatever work has to be done has to be completed by the following year. So they call that the economics performance test. And you can see some examples of that mentioned in the textbook. Okay, so make sure you work on your Learn Smart practice problems and do the homework assignment and review all of that before taking the chapter quiz. I'll have another video up to go over our sole proprietorship Schedule C.